Hello students, this is Professor Vicente Saga. Welcome to my class. This is part 3 of chapter 14 presentation. In part 2, we are talking about valuation of a bond. And just to help you with, as a refresher of what we discussed in part 2, we said that there are two important interest rates relative to the calculation or computation of the value or the price of a bond. We talk about the stated interest rate, we talk about the market interest rate. Now, we went further to talk about the relationship between those two interest rates. So here is the example we were illustrating. And let's assume that a company issued a $10,000 bond. It is a 5-year bond, and the stated interest rate is 8%, and the market interest rate is also 8%, all right? So here is what is happening. When a bondholder buys the bond, the company issuing the bond is promising to pay the bondholder $10,000 in 5 years and 8% interest every year for the next 5 years. Now, so if the bondholder investor goes to the financial market, the best he or she can do is also 8%. So because the market interest rate and the stated interest rate or the face rate are the same, the bond will be sold at par value. What does that mean? Meaning the bond will be sold at exactly $10,000. The issuing company does not have an incentive to sell the bond less than 10,000 or more than 10,000, does not have the incentive to sell it for less, and the investor does not have the desire to pay more either, because the market interest rate and the stated interest rate are the same. So in such circumstance, we said that the bond is value or is worth or it will be sold at par value. Now, let's take a look at the situation. 6 months later, the market interest rate went up to 10%. Now, the company is still in the business of issuing this bond. Now, what is the company going to do? The company cannot use a whiteout to clean up the 8% and put 10% because it's a legal document. You can't do that. You can't alter it. But the company is still interested in selling as many of these bonds as possible in order to raise funds. So here is the problem that the company will run into. No investor is willing to buy this bond and get paid 8%, lousy 8% every year for 5 years, when the same investor can go out in the market and enjoy 10%. So the issuing company is stuck. You can't sell it for 10,000. So the issuing company is not obligated to sell it less than 10,000. So let's assume that the company will now sell it at discount, meaning less than the par value. Let's assume that the company will now sell it at 8,000. I'm really not doing the actual calculation in terms of using the time value table to actually figure out exactly what the amount is. This is just for illustration purposes. We are going to get into that in a minute, okay? Just to make it simple for you. So guess what happened? So the company, when the company sold the bond at 8%, that means the company is going to receive at 8,000. The company is going to receive $8,000. But at the end of 5 years, the company is going to be paying the investor 10,000. Wait a second. Why would the company be willing to receive only 8,000 and pay the investor 10,000 in 5 years? Because the company is making up for the lousy 8% that the investor is going to be receiving for the next 5 years versus what the investor would have gotten in the financial market. So because of that $2,000 difference, in actuality, the investor is actually getting 10%. Even though the investor is going to be paid 8% every year for the next 5 years, but guess what? The investor paid only $8,000, and the investor is going to receive $10,000 at the end of 5 years. So that $2,000 discount make up for the difference between 8% and 10%. Again, like I said, it is very important that these numbers are not real. I'm just using the regular numbers without going through the troubles of actually calculating them using present value, future value concept, okay? So let's take a look at what happened. In another 9 months later, guess what happened? The market interest rate went down to, let's say, 6%. So the market interest rate is now 6%. Now guess what? The company is still in the business of selling this bond. But here's the trick. The company issuing the bond is no longer willing to sell this bond for $10,000 and pay 8% interest every year for the next 5 years when the market is only paying lousy 6%. Are you with me? So from that standpoint, when the company is still selling the bond, the company will now sell the bond, or the bond will now be sold at premium. In other words, the bond will not be sold more than the par value. Again, I'm just making up numbers. Let's assume that we have $13,000. So guess what happened? The company is going to receive $13,000, but the company is going to be paying the investor $10,000 in 5 years. Why is the investor willing to cover $13,000 and receive $10,000 in 5 years? Because the investor is going to be enjoying 8% interest for the next 5 years, whereas the market is only paying lousy 6%. So what did we establish here? Number one, if the stated interest rate and the market interest rate are the same, the bond will be sold at par, exactly $10,000, at par value or at face value. However, if the stated interest rate is lower than the market rate, then the bond will be sold at discount. Then if the stated interest rate is higher than the market rate, then the bond will be sold at premium. It is extremely important that you understand this concept. Now the question is, what do we do with the difference? So let's take a look at this situation here, where the bond was sold at discount for $8,000. That the company is going to pay $10,000 at the end of 5 years, but the company only receive $2,000. Now let me back up. So take a look at what happens. Every year, the cash interest payment and the interest expense when the bond is sold at par value will be the same. However, when the bond is sold at discount, as you can see, we receive $8,000, but we are going to be paying $10,000 in 5 years. That $2,000 difference is additional interest expense to the company. Whereas for the premium, that $3,000 difference, the company is receiving $3,000 more than what they are going to pay in 5 years. That would decrease the interest expense. So let's go ahead and we are going to get into that in a minute, and we should be able to hit that home with some illustrations here. So moving along, we talked about 3 different possibilities in terms of valuing or selling the bond. Here is this slide. The stated interest rate is 8%. As you can see, when the market rate is 6% and the stated rate is 8%, the bond will be sold at premium, par value, discount, just like we illustrated. Now, still talking about valuation of bond. Here is an example here. Service Master Company issues $100,000 in bond due in 5 years with 9% interest payable annually at year end. At the end of issue, the market rate for such bond is 11%. So what do we have here? $100,000 in bond due in 5 years, 9% interest payable annually at year end. That means the stated interest rate is 9%. However, the market rate is 11%. So the market rate is higher than the stated rate. So clearly, this bond will be sold at discount. So how do we calculate? This is very important for you to know. This is going to be on your exam, on your quiz as well. The question is, given this fact, what is the value or what is the price of this bond? We know from the outset, because the market rate is 11% and the stated interest rate is 9%, this bond is going to be sold at discount. And the par value is 100,000. So it's going to be sold less than 100,000. Exactly how much is it? In comparison to the example I just illustrated, whereby I really didn't crunch the numbers properly. So take a look at what we are going to do here. You need to know this for exam. So the $100,000 is due in 5 years. That is a single sum. So the company is going to pay $100,000 in 5 years. So we are going to use the proper table. The way it's done here. Okay, so we look for the present value interest factor using table 6-2 in your book, and we look up at the present value interest factor for in this case 5 years, but this is a single sum. So the present value interest factor is 0.59345. So we multiply that by 100,000, that will give us 59,345. Now, we are now going to look for the present value of the yearly interest payment for the next 5 years. So the interest payment, remember now, the cash interest payment is calculated by multiplying the par value by the stated interest rate. So something I want you to know here, for the first calculation, 100,000 present value interest factor of a single sum. I want you to know here that when we look at the table, we are going to use the market interest rate, in this case 11%. So, and that will give us 59,345. Now again, the $9,000 interest that we are going to pay every year for the next 5 years, as you know, is an annuity. Remember, in intermediate accounting 1 and your principles of finance, we said annuity is the same amount that is paid in the same interval of time. So every year for the next 5 years. So that is annuity. So the question is, what is the present value of $9,000 every year for the next 5 years? Now we look for the present value interest factor of annuity using table 6-4, and the factor is 3.69590. I want you to know something very important here. In calculation of the 9,000, we use the stated interest rate, because the $9,000 is actually the actual cash interest payment. But then when we look at the table, we use the market interest rate, in this case 11%. So when we do the math, take a look at this. The present value of the single sum is 59,000. The present value of the interest payment is 33,000. Add the two, add this up, and you come up with 92,000. So obviously we are selling the bond at 92,000 and the face value is 100,000. Why are we willing to sell the bond for 92,000 when we are going to cough out $100,000 in 5 years? Because we are making up for the higher market interest rate. Because the investor would have gone out somewhere and enjoy 11%, but we are going to be paying lousy 9%. So we are now willing to sell the bond for less than the par value. Now, of course, we're going to talk about how to deal with the difference in a minute. So that is the conclusion of part 3 of this presentation.